It's an urgent alert. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, you need to sell now before this entire sector crashes. I'm going to show you why the big players are dumping shares and why you need to act now. Plus, retailers are growing increasingly concerned. I'll show you why this is going to send millions of Americans to the unemployment line. And can Libya send the U.S. economy into a recession? I'll show you exactly how they can. Now, let's over to Bloomberg, where we picked today's story up with the headline, as Warren Buffett sells more Bank of America shares, reaping $982 million. And this doesn't make any sense, because if we are going to experience a soft landing and we're in the beginning stages of the next bull market and economic expansion, then the last thing you'd want to do is sell bank shares, because that's where banks make money, is during expansions. The problem here is that big players like Warren Buffett aren't buying it, and neither should you. His Berkshire Hathaway Inc. has trimmed the stake by a total of almost 13% in a series of sales since mid-July, generating $5.4 billion in proceeds. Berkshire disclosed in its latest disposals in a regulatory filing late Tuesday, detailing sales this month on August 23rd, 26th, and 27th. Buffett held silent about his reasoning while whittling the highly profitable bet, the investment that began when the stock was trading near $5 in 2011. And there's good reason he's silent. He wants to get out while there's so much euphoria about buying stocks at all-time highs and driving the market higher. Investors can't get enough, but there's something he can't get enough of, and that's cash. In addition to the B of A selling, Berkshire dumped half its Apple shares and other securities, sending its cash pile soaring by a record $88 billion to an all-time high of $277 billion at the end of the second quarter. And why is he doing this? Well, it makes perfect sense, because if the Fed is going to start cutting rates, then this is his opportunity to lock in a return for the next 6 to 12 months on his cash. Plus, there's a big correlation to what happens when the Fed cuts rates in the economy, which we'll look at in a moment. But this is a key point, because rates are still high and he knows they're going to come down. He's betting that he's going to get a better return in his T-bills than he is in equities. And when we take a look here at the stock market cap to US GDP, or what's better known as a Buffett indicator, it's still very elevated. But as we turn back to Bank of America, maybe Wall Street Journal's got this right. If the Fed were to make 3 quarter-point cuts before the end of the year, the bank expects its quarterly net interest income would be lower by roughly $225 million in the fourth quarter from the second quarter, which could send the stock significantly lower. But that's not the real case here. It has everything to do about the economy, because what's going to happen to the banks is going to lead to the value of their stock heading significantly lower. But if you want to know what to buy and when, check this out. As of close of business yesterday, our CTA Timer Pro had 26 open trades now. That's up as a 100% win rate. We closed out one of them yesterday. We started the day with 27 trades. That was for a positive return. We currently have 13 open trades on Momentum Timer Pro. That's a 100% win rate. We closed one of them, the 14th, out yesterday for a 2.64% gain. And you want to know how to make money trading? You want to know where the market is headed? You want the edge? We give it to you. And those are impressive win rates. And the best part is you can duplicate every single trade we do. It's very simple. Now, how do we do it? Well, we look at the machine positioning every day across a broad equity, bond, currency, and commodity markets. And we look for when the machines are in deep short position. When price rallies against them, that flags our report. Now, we do the same thing in terms of the broad equity, bond, currency, and commodity markets, but also with momentum play. If you like to trade things like the RSI and the MACD, but you get them wrong, well, we aggregate a bunch of technical singles, run a proprietary overlay that nobody else uses, and then we run it over long periods of time. We look for shifts in the 1, 3, and 6 month momentum, and when that happens, it flags our reports. But here's the best part. You can get both reports. You can get all of the signals. I give you my opinion on the ones you should do. We give you stop loss levels. We track every trade and return, the good and the bad. We update your stop loss levels for you every week on the weekend. It's 100% duplicatable. And here's the best part. Everyone else wants to charge it because they know their system doesn't work. We give you 30 days free, because we know when you start making money, you'll be a subscriber for life. Check out the links in the description below. Now let's take a look at some more charts here, because what Buffett knows is financial conditions are tightening, and when that happens, it's not good news for the banks at all. We're going to look at the yield curve here against commercial industrial lending, and the yield curve is expressed as the 10-year minus the 2-year. Now, when you see it below that horizontal black line, the blue line there, well, what that means is 2-year yields are higher than 10-year, which is not normal. But look what happens when you see the curve steepen, which is indicated as rates fall. Look at commercial industrial lending. This is shown on a year-over-year rate of change. What happens? It goes down, and you can see that happen each and every time. And this is critical because banks make money lending. That's the best way they make money, is on the spread of interest rates and when people come in and borrow. But what we see is when rates go down, when financial conditions tighten, well, it doesn't work out well for banks at all. In fact, throughout history, we can see this relationship. So we talk about what Buffett's doing here. He sees rates are about to come down. He wants to lock in some of that short-term yield because he knows if he's got to sell his bank stocks, because what we're going to see in lending is it's going to plummet. And this is opposite of what's expected by investors. They believe low interest rates will lead to more lending. But history shows it doesn't work that way at all. In fact, another issue that Buffett's probably well aware of, and that's the delinquency rate. We're going to look at credit card loans here. That's shown in red against the federal funds rate. Again, everybody believes that when the Fed cuts rates, well, things get better. But check this out. When the Fed starts to cut rates, you see an acceleration in delinquencies. You see that happen here again in the dot-com bubble. The Fed's cutting, delinquency rates go up. It happens again in the global financial crisis. It starts to happen as we head into the pandemic, and now it's beginning to happen again. Delinquency rates are rising, so he's looking to make a smart move here. Why would he want to hold banks when delinquencies are rising and loan demand is about to come plummeting down? Not a good recipe for success. And as we turn to retailers, well, we find out that the U.S. economy isn't that strong as everyone believes, and it's about to send even more Americans to the unemployment line. As we look at Kohl's shares rise as it lifts full-year profit outlook, check this out. The company experienced softness in its core business last quarter. So remember, we were supposed to be heading into a soft landing, and yet they still are seeing weakness. But the problem is they're not seeing it turn around at all. The retailer slashes comparable sales guidance, however, after a 10th straight quarter of declines. The CEO said there was continued softness in Kohl's core business last quarter, but categories such as gifting, impulse, and home decor did well. During the second quarter, our customers exhibited more discretion in their spending, which pressured our sales even as customers transacted more frequently. So what does that tell you is happening at Kohl's and other retailers is people are looking for a deal. So they're going there trying to find a deal. If they find it, they're buying it, but they're not buying much else. They're willing to come back because they need to save money. It's telling you everything you need to know about the strength of the economy, and it starts to make perfect sense of why Warren Buffett would want to unload his Bank of America shares, because he knows the economy is turning down and he'd much rather buy them when they're cheap. And this is a classic death spiral where poor performance leads to cost cutting and crimping, which then leads to poor execution and then leads to falling sales. See, I disagree with this. I think we need to rewrite this paragraph here. Very simple. This is a classic death spiral where a weakening economy, those are the key words, leads to cost cutting and crimping because higher wages and higher inflation have impacted businesses, which then leads to poor execution, which then leads to falling sales. And that, my friends, leads to more and rising unemployment. And here we can see when we look at advanced retail sales, as shown in blue on a year-on-year rate of change, against the delinquency rate on credit cards, you look at the pain that retailers are about to experience, and it makes perfect sense. Because if you're in delinquency on your credit card, well, guess what they're not going to give you? And that is an increase in your credit limit. And you see here, that leads to a direct impact on retail sales, because we know most Americans buy things that they don't need with money they don't have, and that's called a credit card. You can see that relationship here over and over, and now we're in the beginning stages of it. Everybody's hoping for a rebound in retail. What we're hearing from Kohl's, it says not likely, especially as we see rising delinquencies. And all that's going to do is put more people on the unemployment line as we look at real retail sales, this being inflation adjusted in blue against continued unemployment claims, because as retailers see demand go down, well, they need to cut costs. And the easiest way to do that is to cut employees. They hit the unemployment line and find out there's no work anywhere else. And what what you see here is every slowdown there in retail sales leads to people hitting the unemployment line and staying there, and we're seeing that early phase now. Many people believe that this is the peak of the worst of continued unemployment claims. Based on what we're seeing alone from Kohl's, it says the worst isn't over. In fact, it's going to get a whole lot worse. Let's take a look at Foot Locker here, because their stock falls as investors, unimpressed by progress, you start looking at companies. They're doing everything they can to get people in the door to get their money, because they realize the economy is slowing down. They realize consumers don't have that much money, and so all out battle to get it from them. The sneaker seller snapped 5 consecutive quarters of negative comparable sales, with a 2.6 gain for the quarter ending August 3rd, outpacing the average analyst estimate. But revenue of nearly $1.9 billion also surpassed expectations. But get this, one downside of the results was the chain reiterated its sales guidance for the year rather than increasing it, suggesting that even Foot Locker knows things are going to get worse. And that's the challenge here. The more we hear from retailers that consumers are tapped out, spending less, focusing on deals, that means you're going to see retailers have to cut their budgets, cut their expenses. They're going to put people on the unemployment line, and we're going to see this downward spiral. But one of the big challenges right now is Libya could send the U.S. economy into a recession. Let me show you how that could happen. As Libya oil output now drops 400,000 barrels a day amid shutdowns, this means we're taking supply off of the market. In fact, their output almost halved this week, and risks of taking close to 1 million barrels a day off the global market as the country's fields reduce operations amid a stalemate of, get this, over who controls the central bank. Well, we know, of course, that doesn't really matter much because the central bankers have no power over the economy, but it's an important issue for them. The issue here for the United States is the fact that we're going to see less supply come onto the market at a time when what most consumers really need right now is oil prices and energy costs to drop, and a lot. It's against this fragile backdrop that OPEC Plus cartel led by Saudi Arabia and Russia must choose whether to implement plans to start increasing output in October. I'll tell you why they don't want to do this, because right now they're scheduled to add 543,000 barrels a day during the fourth quarter, the first stage in restoring production that's halted in late 2022. The problem is that we're already seeing expectations that global inventories will accumulate next quarter, even if the group increases supply. In fact, producers only have a limited scope to add barrels. This from trading house Trafigura. With Brent crude below 80 a barrel, too low for many OPEC Plus nations to cover government spending, Citigroup and BNP Paribas believe the group will postpone the hike. That will send energy prices higher, and of course, it's going to be a huge problem for U.S. consumers, particularly as we look at the inventory data. This from Zero Hedge, as WTI extends losses after smaller than expected crude drop. Take a look at the Department of Energy. Here we see crude oil inventories drop 846,000 barrels. That means demand is outpacing supply. How about this? Gasoline down 2.2 million barrels. Distillates up just slightly, 275,000. This means energy prices are going up. And when we talk about the U.S. consumer, when we talk about hitting a recession, this is the exact problem we face, is that when consumers get strapped, when their bills go up and they have less money to spend in the economy, which is exactly what Kohl's is saying. It's exactly what Foot Locker is saying. And in fact, you turn back to Warren Buffett, even he realizes it, because you're seeing rising delinquencies in the bank. Everything's pointing to the U.S. consumers are out of money, and this is exactly how Libya could hurt us, because look at regular all formations gas prices, this shown in red against real retail sales still in blue, and what you see is rising gas prices have a huge impact on retail sales, because that means consumers have less money to spend, and when they do that, they hit the unemployment line and start racking up delinquencies. You can see this relationship happens each and every time you get a spike or a rise in gas prices is persistent and the economy can't keep up with it. We look at right now, what do you see? You see this underperformance in real retail sales has much to do with rising gas prices, and if we don't see oil start to come back online and in a big way and bring gas prices down, well, it means we're headed into a recession. but this is one the Fed won't stop. Because the Fed embraces gradualism now, a familiar policy for uncertain times. They believe that cutting rates slowly will help. Well, the fact is we know cutting rates won't make any difference, and if it did, it's far too little too late, despite the fact that Powell claims he's ready to move aggressively. And here we see they have significant question around them now in terms of the labor market weakening. They need to start removing the restriction. The reality is it's way too late for that. We're already seeing the beginning phases of the U.S. labor market unwind. In a matter of months, we're going to see millions of Americans headed to the unemployment line. And now it starts to make perfect sense why Warren Buffett is dumping bank stocks and why you may need to too. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.